Chapter 3, Concept Video Number 1, Adjustments for Financial Reporting. So far in this course, in Chapter 1 and 2, you were introduced to the accounting process, which is one of analyzing, classifying, and summarizing business transactions into accounts. You learned how these transactions are entered into the journal and then posted to the ledger. You also know how to use a trial balance to test the equality of debits and credits in the journalizing and posting process. Now, the purpose of the accounting process is to produce accurate financial statements so that they may be used for making sound business decisions. At this point in your study of accounting, you are concentrating on 3 financial statements: the income statement, statement of retained earnings, and the balance sheet. There's a 4th statement called the statement of cash flow, which we will talk about much later. Now, when you began to analyze business transactions back in Chapter 1, you saw that we needed evidence that the transaction actually took place, and that required a source document. That is, any written or printed evidence that describes the essential facts of a business transaction. Examples are receipts for cash paid or received, checks written or received, bills sent to customers, or bills received from suppliers. Now, the giving, receiving, and creating of source documents triggered a journal entry that we made in Chapter 2. Now, the journal entries in this chapter are called adjusting entries. We have arrived at the end of the accounting process, and that triggers the need for adjusting entries. Accountants use adjusting entries to bring accounts to their proper balance before preparing financial statement. In this chapter, you'll learn the difference between the cash basis and accrual basis of accounting. Then you will learn about the classes and types of adjusting entries and how to prepare them. The cash basis of accounting recognizes revenues only when cash is received, and recognizes expenses. When I mean by recognize, record in the records. And they only record the expenses when the expenses are paid. That's the cash basis of accounting. We do not do that. What we do is the accrual basis of accounting, which recognizes revenue when revenues are earned. That is, when sales are made or services are performed, regardless of whether we receive cash or not. And we record expenses as they are incurred, whether or not we have paid them up. For instance, assume a company performs services for a customer and account. Although the company has received no cash, the revenue is recorded at that time. So we as accountants use the accrual basis of accounting, which matches expenses incurred to revenues earned. To illustrate, suppose that Fresh Color paints a large building in 2011. In 2011, incurs and pays total expenses of $50,000. It bills the customer $80,000, but does not receive the money until 2012. So you see, on a cash basis, if we were to prepare the financial statement on a cash basis, we would say we didn't receive any revenue 2012, but we paid out expenses, so we have a $50,000 loss. But then in 2012, we received money and we paid out no expenses. So you can see a large loss in 2011 and a huge profit in 2012. That's the cash basis. We're only recognizing revenue and expenses when we receive the money. The accrual basis says, look, you did the service in 2011, so you recognize it. And you incurred those expenses in 2011, so you recognize that. You have a net income of 30. And nothing happened in 2012. So you see how much better the accrual system is. Now, in order to prepare financial statements, we have to divide the business entity's life into time periods, usually of 1 year. It could be less than that. It could be a month, it could be a quarter, or so on. But because of that, we now need to adjust entries between the time periods in order to match revenue and expenses. This is called the matching principle, and it's one of the underlying principles of accounting. Adjusting entries fall into 2 broad classes. They're deferred ones, meaning they're postponed or delayed items. And there are accrued ones, meaning that they continue to grow or accumulate. Deferred items consist of adjusting entries involving data previously recorded in the accounts, But these entries involve the transfer of the data already recorded in the asset and liability accounts to the expense and revenue accounts. Now, a demonstration will show that more clearly. Accrued items consist of adjusting entries relating to activity on which no data has yet been recorded. And here's a number of adjustments for deferred items: prepaid insurance, prepaid rent, supplies on hand, depreciation, unearned revenue. They all are in my records at the moment and have to be adjusted. Examples of adjustment for accrued items: accrued assets are assets such as interest receivable or accounts receivable that have not been recorded by the end of the accounting period. So accrued actually means incurred but not recorded. So accrued revenue is revenue I've earned but I have not recorded yet because I haven't billed the customer. Accrued liabilities are debts that I have incurred, but I have not recorded that because I have not received a bill for that yet. Nevertheless, I must make adjusting entries so that I have the revenue and expenses in the proper year. And that's the need for adjusting entries. In the next video, we'll go through some examples.